Good morning, everybody. Today is March 11th, 2020, and it's Wednesday. And we have another huge drop on the market, which is 1,000 points, but frankly, it doesn't feel that huge compared to the 2,000 point drop that we just had 2 days ago. So we're almost getting used to such huge volatility. But it's if you're trading stock options, and this is what I've been doing till lately. Obviously, this is a problem, and the reason is that when the volatility is huge, the option prices are out of control. Option prices basically allow you to freeze the current price of the stock on a certain level for a fixed price. So for example, if the stock is trading at $100 and you want to lock this price, before you would pay, let's say, $2-3 to do this, because nobody was expecting that the stock will jump over $103, $102. So that's why they were already kind of like, putting in this potential profit into the price of the option. However, now nobody knows what's going to happen with a $100 stock. It could be a $120 tomorrow, like what happened yesterday when blue chip stocks, huge stocks, were trading like penny stocks, meaning that they would jump in price by 15%. And we're talking about the companies that are worth $100 billion. It's okay for a small cap stock that is worth $20 million to jump 15% and increase its market capitalization by $2-3 million. But to increase market capitalization by $20 or $30 billion, I mean, that's kind of like you need to have some kind of major development for the company or great earning results. Even that would not be enough. But nowadays, hey, 20%, no problem. Blue chip stock, no problem. Which means that if you want to freeze a stock at $100, they look at it and they say, well, if we look at what happened to the stock in the last 3 or 4 or 5 days, it could easily go from $100 to $120 a share, which means that don't pay us $3 to freeze the stock at to freeze the stock price at $100. No, pay us $20. And now you're like, well, it's kind of expensive, because what if the stock doesn't jump that much, and what if I'm not going to make that much money? So I think option volume is going down nowadays because they're just very expensive, so that's why I switched right now into trading stocks and ETFs directly, without purchasing any kind of stock options, because when you buy a stock, you get the current price on the market. You don't have to throw in another $10, $15, $20 of the current price to the seller, because he thinks that it's going to jump that much tomorrow, right? So nowadays what happens is that you buy a stock, you do it in multiple transactions. Thank God we have this zero commissions now trades, and I think this also is a contributor to this huge volatility. See, before October of last year, people were not as active on the stock market as they are before. And the reason is that before, for example, if you had $100 or maybe a couple $100, you were not really a player on the stock market, because your commission was, let's say, $8 to buy, $8 to sell. So let's say if you're trading just $100, it cost you $16 to buy and sell the stock. So which means that the first 16% of your profit needs to be given to the broker as a fee. So unless you're making, let's say, 17, 19, 20% profit on your $100 investment, then it doesn't make sense for you to get in. However, everything changed in October of last year. Suddenly, if you want to invest $100 into the stock market, hey, no problem. You know how much it's going to cost you? $0. You know? So, if you invest $100 and your stock or your position goes up just by 1%, which could easily can be done in one day before, and nowadays it's like almost granted that their stock is going to fluctuate that much, if not more. So now we have a lot of people who rushed into the market with maybe not very significant finances in terms of the investment portfolios, but they're very happy trigger happy, and they're pulling the trigger very often because it costs them nothing in commissions. So, and I encourage you to actually use this to your advantage, because as I said before, we're not God to predict the exact low for the stock for today, for example, or for any time period. But let's say we're talking about the day span of the trade. So the stock is trading at $100, then goes to 99, 98. You look at it and you say, you know what, this is very low, I'm gonna get in, I'm gonna buy it. So you buy at $98, and suddenly the stock goes down to 97 or 95, and you're like losing money. You're like, oh my God, I made a mistake. So nowadays, what you could do is you could lower your risk tremendously by doing the following thing. Let's say you think it's a 98 is a good price. Okay, don't invest. Let's say $1,000 all in one time. Put a buy order at 98. Immediately follow this order with another order to buy at 97, another order at 96, and even 95. Okay? In most cases, the stock will go down a little bit more, maybe much more from your original price, original purchase price. But guess what? You are, with your additional trades at zero commissions, you are ensuring that your average purchase price is going down as well if the stock goes down. So if you set up this multiple trades with a discount to the current price by, let's say, 50%, $1, $2, it depends on the price of the stock, obviously, and the stock goes through its usual corridor, up and down, up and down. When the stock goes down, you're gonna harvest all these low prices and get yourself a great average purchase price that you could sell later at much higher price and lock in the profits. So if you want to know which stocks to buy in this volatile market, please go to the website 2stx.com. It will take you directly to the Apple App Store, where you could download, install, and run my app on your iPhone, iPad, and Apple TV, and it will give you daily buy and sell recommendations for 5,500 stocks. So thank you for your time. Stay healthy, don't get coronavirus, and good luck trading.